talked about the venture capitalist, and let's spend some more time talking about the details of developing the financing, because as you can tell from my discussion, one of the important aspects is, how do I pay for all this? You need money to pay for all this. Nobody's going to hand this to you gratis. You're going to have to pay for this, and how do you pay for it? Well, as I said, once you've exhausted your friends and family, then you go to the venture capitalists. Now, these are angel investors, and they're willing to put in, $100,000, $200,000 to launch you. They're called angel investors, okay? So there's a series of these investors, and each one has a limit about the amount of money that he or she or the company will invest. So first ones are angel investors. They're venture capitalists. They're individuals that typically will invest a certain amount of money. They stand in the next step after your family and friends. And they'll probably invest $100,000, $200,000, $300,000 for a percentage of the action. Okay, but obviously that's not going to get you to first base with your physical plant and all that. So after the angel investors have put in the money and you've advanced your proof of concept to a certain point, then you've developed your business plan, then you go to the true venture capitalist company. But obviously, that's not going to get you to first base with your physical plant and all that. So after the angel investors have put in the money and you've advanced your proof of concept to a certain point, then you've developed your business plan, then you go to the true venture capitalist companies like 5AM Ventures, like Versant Ventures in California. There are a couple of venture capitalist companies around here. In fact, Rick Brimacombe runs at our firm runs a venture capitalist company where they invest fairly large sums of money. How do these venture capitalists come up with these large sums of money? Well, okay, so very well off, usually older individuals who have made their fortunes in the stock market or were business people who started companies and made millions and millions of dollars. They have money to invest in risky organizations like this. So they know they don't have enough time and effort to go out and hunt for these. So they put their money into a venture capitalist company like 5AM Ventures or like the Brimacombe Associates. And so there is a consortium of very wealthy individuals, and each one puts in, say, $5 million into the venture capitalist fund. And so the venture capitalist fund then has maybe $50 million in which to invest. Now, they're not going to invest the $50 million all in your company. They tend to spread it around, but they are professional investment companies, and they will look at your business plan. They will do their own separate independent evaluation of your product and of the legal aspects of your product, and they will decide and make a recommendation to their investors about investing in your company, and if everybody agrees, then they will invest in your company. So that's the next step. That's the venture capitalist step. And if a venture capitalist company decides to fork over the money, they're going to give you $20 million, $40 million to develop. Okay. Their plan is that your company will be successful and they will do the IPO, or they will be involved in the IPO. And so for the $40 million that they put into your company, they're going to make maybe $400 billion. They're going to make it 10 times or 20 times whatever they're putting into your company. That's typically how they assess whether to invest, is they decide, okay, what is the X factor here for our investment? And they have a bottom line. They have a minimum X factor that they look at. And so they evaluate your company, they evaluate your business plan, they evaluate the product, they evaluate the market, and they decide, okay, based upon that, our judgment is that this product, if it's up and running, it'll sell, say, I don't know, $200 million worth of product a year, okay? And so if we put $20 million into this company, then it's a 10x a year, all right? So that's often how they figure out whether to invest in your company, is they have an X factor minimum that they want to see. Okay, so that's the venture capitalist, okay? Sometimes venture capitalists don't have enough money to take your company to the IPO stage. And so there's another factor, there's another kind of company between the venture capitalist and the IPO, and that's an investment bank. Sometimes in these situations, the venture capitalists don't have enough money to take your company complete from the startup phase, from the initial phase, from the friends and family, from the angel investor stage, all the way through the IPO. It just takes a lot of cash in order to do that. So there's an initial round of financing, and the venture capitalist company has put in the initial round of financing, but now you come back and you need a second round of financing. Let's say the first round of financing was $40 million. Now you need another $80 million, but your company is halfway there. You've got a product, it's beginning to sell, and you need to expand. You need the $80 million. So in that situation, you look for investment banks, the Goldman Sachs, the Morgenthau banks, the big investment banks in New York, the big investment banks in Switzerland. They're the ones that would provide this money. Now, they provide the money on a slightly different basis. Their basis is a quasi-loan. They will take a percentage of the company, but it's a small percentage, and what they do is they will have you sign a loan agreement at a fairly hefty interest rate, and they will give you the $80 million. They're making, it's not a risky bet, but they're figuring you've got that if your company doesn't succeed, you've got enough assets that they can come in and they can sell your company, and they can make their money back selling your company, breaking it up in pieces. Okay, so investment banks, that's what an investment bank does, and they are investing in your company. They may ask for preferred stock. They may ask for a combination of preferred stock and loan guarantees, and by loan guarantees, what they mean is if you go bankrupt, they are first in line before any other creditor. That's what they mean by loan guarantees. So that's an important step between the venture capitalist and the IPO. Often what happens is, let's say as the initial startup company, you've given your 4 people each, well, you've taken 40% of the stock, and you've got 3 other people, and you've given each of them 20% of the stock. Okay, so, and they figure, oh, you know, if the company winds up to be $100 million company, then I've got 20% of $100 million. That's great. Okay, but here's what many times happens. Your initial stock that is closed stock, and when you get to the investment bank stage, or you get to the venture capitalist stage, what happens is there's a reinvestment and I forget the buzzword, but a re-evaluation of the stock. And what happens is the venture capitalist company or the investment bank says, okay, we're going to reincorporate your company, and we're going to issue 100,000 shares. Okay. And so the 20 shares for 20% that your business person had is now worth not 20% of the 100,000 shares, but it's worth, let's say, 200 shares. Why? Because the investment company or the venture capitalist has said, we're putting in $40 million, and so we should have 80% of this reincorporation stock. What's happened? All of a sudden, the 20% of the company that your business person owned has been diluted down to 2% or 1%. So this often happens. And that's the way the cookie crumbles. I'm sorry, but that's a fact of life. And so the amount of dilution that happens is going to be dependent upon how far you've taken the company before you need these investments. So you need to be smart about when you need to look for money, when the investments happen, and dealing with the investment company and the investment bankers. Because if you do deal too early and you have nothing to offer, nothing to say, you don't have any patents, you don't have any product that's already ready to go, you've got nothing, the investment banker has everything, you need the money, and you're going to get diluted. That is the golden ring. That's what you've been looking for. That's what the venture capitalist is looking for. That's what the bankers have been looking for. That's what your business person, that's what she's been looking for. That's what your product developer is looking for, is that initial IPO, initial public offering as money. And of course, what happens is the closed corporation stock then is sold into this public offering, and so your initial investors, the venture capitalists, your business people that took the high risk, they get a percentage of the $100 million that's coming in. So that's the golden ring. That's how you make your big house on the beach in Hawaii, for example. So that's the initial public offering. But there's a long distance between where you are with your 3 people and your concept and your advice from the counselors, from the consultants, and the initial public offering. You need to demonstrate profitability and all that in order to get to that point. In summary, as you've just heard, the IPO is the golden ring you should strive for, irrespective of whether you continue to build your company or to sell it. There are many steps to go from your original idea to that IPO. I hope you found this presentation useful in those regards. You can contact me at anelson@slwip.com or phone me at 612-373-6939. That's all, folks.